Welcome back to Drilling It Down, the quick edition. This is your host, Wes Lyon, President and CEO of McGill and Lyon Dental Advisors. And next to me, I have Tyler Rott, a tax and business planning advisor here at McGill and Lyon Dental Advisors. Ty, welcome.
Thank you. Thank you for having me.
And you wrote this article, Tyler, so we want to talk today about the savings of employing your spouse. And I think we've got obvious ones, but we got non-obvious ones. So Tyler, real quick, give me the obvious one.
Obvious one is if they're not eligible for a retirement plan elsewhere, or they don't have a job elsewhere, they're able to make the full salary deferral into the practice retirement plan, which ideally is a 401k. Probably going to save about $10,000 of tax just by doing that.
That's perfect. Quick, easy. If you don't even know that one, you need to go subscribe to our newsletter. Go to McGillandLyon.com, get a bunch more information. Now, though, we want to jump into the hidden ones here, Tyler. Everyone kind of knows that one, but there's a lot of people, their spouse has another job, so they don't employ their spouse, which is a huge mistake. So, Tyler, I'm going to go a little out of order in the article here.
Okay.
Talking about the easiest, simplest one, which is probably... I like to ask the question this way. If you've been paying attention to our blog post or our recent episodes, hey, can you write off the travel cost of your spouse when you go to a nice tax-deductible trip such as our Napa seminar or our St. Thomas seminar?
If they are purely your spouse, no. But if they are employed by the practice, yes.
So that's thing number one is if your spouse is not on the payroll, you can't have a business meal with them and nothing. I mean, they could literally be at an actual business meal, but their portion of it is not deductible because there's not a business purpose to have a non-employee there at this business meeting. So get them on the payroll.
Yeah. How much do you pay them? If they are employed elsewhere, retirement plan elsewhere, we just want them on the payroll, $250 a month, $3,000 a year. If they are maximizing the retirement plan, we have the specific numbers in the article. Take a look at that. But it's really pay them as little as possible to maximize that salary deferral and minimize payroll taxes.
Yep. And then if they do have a 401k elsewhere, don't have them do your 401k.
Yes.
Do the 401k at the other employer because they're going to match it.
Yes.
Right? So you're going to take free money over there. And then, though, this is where it gets a little tricky. So now we know we want to do the salary deferral. Even if we don't, we want them on the payroll because, we want to go to a nice CE trip somewhere, right off a tax-deductible continuing education excursion, not a vacation. We're going to call it an excursion to somewhere nice and tropical. But there's something else in the retirement plan you wrote about. So what else is going on in retirement plans?
Yeah, so when it comes to retirement plans, especially profit sharing and beyond, not just talking about the standard match here, is there's testing. There's discrimination testing with the owners or the highly compensated employees compared to the staff. And the percentage of benefits that a highly compensated employee gets in relation to the staff, they just want to make these regulations and testing just want to make sure that the staff isn't getting discriminated against and they're getting enough benefit. By having the spouse on the payroll, it adds another highly compensated employee to this bucket, helps testing, make that testing that much more beneficial, and that helps with the salary at the full deferral or even at the $3,000. Just having them on the payroll helps.
Yeah, so I think kind of think of this a little more high level. Like, why does the IRS run these retirement plans, and why do they allow the owners to get more money? Well, we got a retirement problem in this country. People don't save money, right? So like, hey, if you want to do this for yourself, you have to do this for your staff, right? So that's kind of the start of it there, and that's why, Tyler, as you mentioned, having them in there helps testing. So I think a little more granular. We don't want to get too granular, but a little more granular is that testing is not the doctor versus the staff. It's highly compensated versus the staff, right? So if we do that, though, now, Tyler, we're getting to a little bit of quirks here. So let's go back and let's say if we're doing salary deferral, we're getting them in and making them eligible. So I'm more concerned about the $250 a month.
Yeah.
Are they automatically in the plan to help with this testing?
They are not automatically in the plan. There are two things that you can do. You can mark your spouse as having worked 1,000 hours in 1 year for the practice at some point.
They are supposed to have previously worked 1,000 hours.
Yes. Yes.
I think we need to put that for legal liability here.
Yes.
They're supposed to have actually worked 1,000 hours if you check that box.
Absolutely.
Now, Tyler, though, I think you kicked off this article with one of my. I love when you ask this question of when you think, did they work 1,000 hours? Were they in there, or is it? Did you get 1,000 hours worth of advice, solicited or unsolicited?
Absolutely. It's just, they're your spouse is likely, having opinions, providing advice on the practice that you're getting daily, likely, and you may enjoy it, you may not enjoy it. So they're working for you.
Let's do the math on this. 1,000 hours is what, about 20 a week?
20 times 40, yeah.
It's about 20 a week. So, do you think that you got, do you think Becca gives me 20 hours a week of unsolicited business advice?
Yeah, I mean, I assume she's giving you advice on how much you should be traveling. So that.
Oh, I didn't even think of that. Yeah, let's not confuse complaints for good consulting advice. I think when your spouse is telling you that you work too much, they're actually giving you business advice that maybe there's a better way to delegate things and do things to not be at the office. I think that's work to me. Yeah. So we might need to get a little creative on how we're getting to this 1,000 hours, but yeah, they have to if they've previously worked 1,000 hours, you didn't have to pay them. You can make the claim that they worked there with my spouse. I didn't have money to pay them, but they had to have provided services for 1,000 hours a year in a previous year.
And they may have helped with, cleaning the office. They may have helped with landscaping, things like that. So,
and a lot of people don't think through this. Oh, they don't do it. Go, well, let's think back to the first year you had the business.
Yeah,
it's probably pretty likely that they helped you for 1,000 hours.
Yeah. Did they help did they help set up your QuickBooks, start doing a little bit of your payroll for you to try and, take some of that off just a little bit? And maybe they scaled back a little bit, but they put in that 1,000 hours on the front end.
Yep. Okay. So now though, let's say we're not good with this 1,000 hours, and we're getting a little scared to fill out the employee census as if they worked 1,000 hours in a year prior. Tyler, what's our other way to get them in?
You can waive eligibility, and then anybody on payroll can be in the plan at that point. So it's you just need to make sure that you're not. If
so,
that's
let me ask clarifying question. You waive eligibility. You said anybody on the payroll can be in the plan. Is that can or will be in the plan?
Will be in the plan.
Okay.
Yes, will be in the plan.
Yeah, so I think that's where we got to be careful if you waive eligibility for everyone. But we do it all the time. Like if you think through this, Tyler, I think you actually got waived in.
Yep.
So I bought the business, and my wife had clearly never worked 1,000 hours because I didn't own the business, but I wanted her in there, and we were using prior service for the last company. So I went in there and I looked, and I think Tyler was the only one at the time who wasn't eligible as is. But then I looked at it and said, well, he's going to be eligible anyways, so I'm going to go ahead and waive him in. So you don't need to be worried if somebody's about to become eligible. They're going to be in the plan anyways. If they get in the plan 6 months earlier than your spouse in, who cares? But what if I have like 4 employees that work part-time, like 200 hours a year?
They're in.
So you want to be careful as you waive eligibility, right? There's not a blatant answer. You probably want to talk to somebody before you waive eligibility. And your retirement plan person, your third-party administrator, are they the best person always to talk to?
Not necessarily.
They can be, right? Yeah, depends how good they are.
some are great, some are not. Some just do the numbers, and it's really got to. We have a great one, but I don't have experience with a ton of other great ones.
We have an in-house third-party administrator here. You can reach out to us at McGillandLyon.com. Hit the contact us if you need a new one. Jared Hollins is the best in the business, and Jared will tell you, hey, before we do this, we're going to waive these 3 people in. And sometimes people don't realize it. Sometimes we intentionally waive a staff member in. Like, let's say, I'm trying to run a cash balance plan, or I'm trying to do profit sharing, and my staff is older and my staff costs are high. I got this like 22-year-old that works part-time. Sometimes we'll just go ahead and say, hey, actually, even though we're going to have to give the 22-year-old $2,000, we're going to give the rest of the staff $10,000 less. We're going to save you $8,000 by waiving her in. Let's go ahead and waive her in. We do that all the time. We look at it and we're like, hey, what lever can we pull on to get these staff costs down?
Jared actually just did that for me for my most recent proposal. I sent him a census, and I said, these are eligible, these ones aren't eligible. I get the proposal back, and some of the ones that aren't eligible are in there. And I go, Oh, I thought they weren't eligible. He goes, we need them in there to bring staff costs down. So, yes,
So
he
yeah.
knows what he's doing.
No, and then Tyler, I think we missed at least one. What other perks do we have adding the spouse to the payroll?
So, potentially doing a business vehicle. So sometimes it's hard to get 50% business use on a
So
doctor
you
vehicle.
need 50% business use to qualify for bonus depreciation,
Yes,
right?
yes.
And for those of you that didn't read, make sure you go check out the blogs, mcgillandlyon.com/blog. Writing off a business vehicle, it's not as easy as they make it on social media. It's doable. I kind of give that one, I like to rate social media tax advice. And people are like, you can have a masterminds meeting and write off your birthday party. No, you cannot do that. That's insane.
Yeah.
But, you can deduct up to 100% of the cost of a new Range Rover. It's like, not necessarily, but very possible, right?
Yeah.
Like, this is a doable strategy. But
Yeah.
the thing they leave out is it has to be more than 50% business use, and your commute doesn't count, right?
Commute doesn't count, so you need to track mileage. You need to track personal use versus business use. Commute isn't personal, or commute is personal. So if
And
you're a dentist with a long commute, it may be hard to get to that 50% threshold. And the first thing that an IRS agent's going to do if they're auditing you is they're going to say, where's my house? Where's my office? Oh, your commute's 30 miles both ways. That's 60 miles a day. You're going there 16 days a week. How are you getting this other, yeah.
Yep. So you're spot on. That's exactly what they're going to do if they want to figure out if they want to audit you. So now it's not to say you automatically qualify for your spouse, but okay, is the spouse doing things? The spouse isn't making that 30-mile commute each way. What else are they doing? Can we get this above 50% use? And, I think, Tyler, you have the larger car of your family, or your wife does, right?
Yeah.
I think that's fairly common for a lot of when the male is the owner, or that the female has the big SUV.
They're taking,
Especially our generation. All the guys like this minivan would be so economical, but none of our wives will actually drive the minivan because their moms drove it.
Yeah.
So now we end up with the big SUV that qualifies for the tax write-off. So you can potentially qualify that way and go over that 50% business use mark, especially it's the doctors in rural areas.
Yep.
It's always the doctor's like, oh, well, I only live a mile from my office, can't write off my vehicle. I'm like, no, that's better. That's a lot better.
That's the perfect one.
So yeah, that's another hidden perk there. But in general, Tyler, everyone should have their spouse on the payroll, right?
Every single one should. Let's just, we get the salary deferral. It's 10 grand. We start writing off, our CE excursions. That's maybe another 10 grand. If you buy $100,000 vehicle, 80%, business use, 40% federal and state taxes. You're looking at overall on year one, maybe $60,000, tax deduction there.
And even if they are elsewhere, sometimes like that staff cost equation, we could spend hours on retirement plan testing. So I'm going to oversimplify it. But when you have your spouse in there, they're considered an owner by family attribution law, which I always love this one when people are like, oh, I don't want this in my spouse's name. I'm like, yeah, well, you can go see the judge if you want to figure out if, you both own it or not. But go to divorce court and you're going to find out you both own it. And that's the same way they view the retirement plan. So a spouse in there at $250 a month, not getting any retirement benefits means one of two owners is getting a 0% benefit. They don't care about the dollar amount, it's a percent. And that's what really brings the staff costs down. So sometimes we're throwing the spouse in there and saving 10 grand to the staff. So, I mean, you are costing yourself money, period, if your spouse is not on your payroll. So at least at $250, but make sure you do it the right way, get it done. And hey, if you need more tax help, anything, we'd love to see you at one of our seminars, mcgillandlyon.com/seminars. Make sure you go check it out. We go through all the tax strategies. You will, if you go to this course and you pay attention and you implement, we are very educational. I promise you, you will start saving money immediately by implementing these strategies. And we are not your social media tax hacks. This is by the book. We do the research. We make sure we will tell you what to do. We'll also tell you what not to do. So make sure you check out one of our seminars, and at the very least, go check out the newsletter. Go to the website, McGill&Lyon.com, hit the newsletter every month, delivered to your inbox, $300 a year. You get 8 articles. Make sure you're in good shape to maximize your profits, minimize your overhead, and make sure you pay the least amount of tax possible, and join what maybe 5% or less of dentists that can actually afford to retire on time. You need to make sure you're one of them, and the ones doing it, the ones that are serious, are reading this newsletter, implementing these strategies. Now, with that said, Tyler, thanks for joining us. We'll be back next time.
All right, thanks for having me.